Hey folks, I think that I'm live. Somebody let me know if you guys can hear me all right. And Elon's just wanted to highlight your comment there right as I saw it here. Um, so I've actually checked out Aptera EV as an investment. It's still way too early for me to look at that. But actually, I have seen their vehicles twice in person here on the road in San Diego. Once just north of where I live in Carlsbad, and once relatively close to here on a back street, and I couldn't believe what I was seeing. But I don't know if they're testing them or if one of the founders lives down kind of close to my area or what. But I've seen two Aptera EVs around town. I think that's pretty cool. But all right, so let's talk about what's going on in the markets today. And did want to acknowledge here that good news for Joby fans. Joby receives Part 135 certification from the FAA ahead of schedule. So, um, not sure exactly what that means. I need to do a little bit more research in there, but they do have someone at their company that is focused just on licensing and regulation issues, which means that I think they're pretty far along in their plans, and they must have some serious money behind them. All right, let's talk about the market. So the market looks like it just closed. I don't know if this is should be delayed a little bit. So Dow Jones is up 517 points or 1.6%. NASDAQ 100 up 3.31, 2.8%, which is a huge day. It was up as far as 3.2% earlier in the day. The Russell 2000 up 2.2%, and the S&P 500 up 77, that's 2%. All right, so what can you learn about today? Well, it's very hard to learn anything about today because the movement in stocks was so broad. Everything was up, and I think it just took a little bit of time for folks out in the investing world to digest the minutes. Well, there's some other good news too, but to digest the minutes of the Fed meeting. And of course, we're getting reporting coming out of Davos right now. And a lot of very important people in finance are actually fairly positive on the economy. And it really has to do with the relative strength of household balance sheets and how good the consumers' personal finances look right now. So that seems pretty good. And Collins Gang says, head fake. Okay. You know what? Absolutely could be a head fake. I've said this for a while now that volatility is not finished. Nobody has a crystal ball here. I don't know that we've hit bottom. I've kind of predicted. I've come on this live stream and made a prediction that, well, and just an observation based on some research that I read, that the natural top for this market, if the price to earnings multiples and the actual growth of the S&P 500 from actual earnings growth, if those two ratios hadn't been flipped, normally it's 70% earnings growth is what powers growth in the S&P 500 and 30% expansion in multiples. Well, that's flipped in the last 2 years or 3 years. It was 70% growth in price to earnings multiples and only 30% growth in earnings growth. If those ratios had been flipped back to what they normally are, then the top of the market would have been at the beginning of the year right around 3,600. That would have been fair valuation for the S&P 500 based on past price to earnings ratios. And we are within 15% of that now. I think that the market can go 15% either way. 15% down from 3,600, and it would still be within normal range for the natural end of the economic cycle, which is where I think we are. We are at the natural end of the economic cycle. I think we are in the middle of a recession, despite I think there's reason to be optimistic, but there's nothing wrong and nothing abnormal about us reaching a peak in terms of the credit cycle and a peak in terms of the industrial cycle, having a few quarters of unwinding, letting some of these supply chain issues unwind themselves over time, dealing with a rise in energy prices, creating a little bit of demand destruction. Yes, creating some unemployment as well. That is all part of the natural end of an investment cycle. And it's not something to be terrified over. And that's one of the things I wanted to talk about today. So, Florin Vraby says, hi, sir. Happy to see you again. So today's live stream is not going to be too terribly long. I'm going to go over a few things about what you should be thinking about doing in this portion of the economic cycle. Why why market timing's most likely not going to work out for you, why a buy and hold strategy, not just at this point, at any point, is probably a better idea. So I do this video. I've made this video a couple of times and people aren't necessarily interested in it. So I'm really doing this as a public service for folks that are really serious about making money over time, in a way that where, I'm not trying to sell you anything or anything like that. I just want to point out some statistical anomalies and some market anomalies, that make market timing a proposition that is almost statistically ridiculous. All right. And that's one of the things I wanted to talk about today. But feel free to chime in and ask questions as I go along. I brought up a bunch of evidence, and that's one of the things lately. I've been seeing that the 10 best days in the market myth pop up in search results. And there's a couple of companies that are calling this research 10 best days in the market a myth. And then they go through their reasoning why it's a myth. And then they don't provide any evidence for why they think it's a myth. They don't demonstrate that it's actually possible to time the market in the manner that they say they can, and they don't show any past results doing that. So this is sort of the best research that's out there. It's roughly 40 years old at this point. The entire body of research, and it's well known. So I want to talk about that. So should you bail out of the market, right? Why should you stay invested if all you keep seeing is red on your computer screens? And I'll tell you why. It's because nobody is as smart as they think they are when it comes to trading stocks and the markets. Nobody has a superpower and can predict the future, although many people think they can. Nobody has special insight. You just have access to the internet and an opinion. Okay. But let's talk about actual investor experience and what actual statistics tell us about the past and how we can time markets. And then we'll go over why the last piece of evidence is so important, and why it's virtually impossible to time markets. All right. And if you get it right once, that's actually the worst thing that can happen to you. Right. You caught one of those natural anomalies. You caught it once, and now you think you can do it all the time. You will end up losing money in this case. So let's talk about this. And the other thing I wanted to talk about was inflation. We now have the Fed committing to half point raises for the next two meetings, for the next 2 months, demonstrating that they're serious about inflation. The unspoken part of what I was talking about yesterday is that the most unpopular thing that people are going to realize when it comes to controlling inflation is that what the Fed is doing is the right thing. It's still going to take time. There is no way to slam the brakes on inflation. We are looking at probably 1 year of seriously elevated inflation, next year of mildly elevated inflation, and maybe by 2024 returning back to normal. So and Shoeless Joe has a question here. Hey, do you think people are ready to risk life and limb in an automated or piloted eVTOL? I'm wondering if eVTOLs will be mostly used for people or packages. So I think for two reasons are probably mostly going to be used for packages. I think that food delivery, Amazon delivery, all that stuff is going to be done by eVTOLs here in the future. And I think that it'll be a while before people accept being driven around just in automated cars. For younger people, sooner. For older people, a little bit later. But I think that in terms of food deliveries and things like that, under 20 kilograms, it's going to be pretty rapid. Like there's a down the street from my house, there is a like an Amazon processing station where there's always like 100 trucks parked out there, and it's like a mini warehouse, and they deliver and then trucks leave, deliver and trucks leave. Man, I can imagine that relatively soon, the next 4 or 5 years, you're going to be seeing, you're going to be seeing these little aircraft take off from there and deliver, the 3 miles to my house. So let's talk about staying invested so you don't miss the 10 best days of the market, right? Time, not timing, is the best way to capitalize on market gains. And by trying to predict the best time to buy and sell, you may miss the market's biggest gains. So we take a look here at the S&P 500 over the last 15 years or so. This is just from 2007 through 2021, and you can see where we chart collapse of Lehman Brothers. We chart you may have forgotten this, the market declined sharply in 2011 when the S&P downgraded the US credit rating, but then it rallied right after that. Honestly, I remember in 2011, people were calling for the death of the stock market again, and the death of, and basically enormously high interest rates on our sovereign debt when that happened. And of course, that never occurred. And another one that folks have probably forgotten about, in June 2016, stock prices plummeted more than 5% in 2 days after the Brexit referendum, followed by a dramatic 3-day recovery. I remember not being too terribly terrified by that, but 2018, 2019 was a big tumble, right? And a lot of folks here still don't remember this. The market tumbled more than 10% on fears that Fed policy error and the U.S. China trade war would cause a recession, right? When we hadn't seen a recession in 9 years, and this is where I think we should have naturally gone into recession. We had a recession here back in 2008. All of this was just natural economic cycle. I think it probably ended right there. We should have had a recession then. They slammed the brakes on raising interest rates. And then the government, actually, the government's budget was out of control in 2018, 2019. They were spending money like drunken sailors. Even before the pandemic, the government was spending money like drunken sailors. We have a giant drop off in 2020. Everyone remembers this. And then we have the new era of pandemic spending and inflation associated with that. And of course, we have asset prices going up because of the removal of the equity risk premium. There's nowhere to put your money. Everything's at zero interest rates. You're kind of driven into stocks at this point, right? So stay invested. So $10,000 invested in the S&P over the last 15 years, from 12/31/06 to 12/21 or 12/31/21. That $10,000 would have grown to 45,682. I will not turn my nose up at that return any day. I think that's roughly, what is that, a 9.5% return over time, or 10.66% return, annualized return over time. You're up 4.5 times over that 15-year period. If you're not happy with that, then there's something wrong with you. Okay. And I mean, I'm going to be quite honest with you. Expecting more than that from any individual stock or mutual fund or ETF that you buy is probably an unrealistic expectation, right? The home runs that you hit, where you buy a Tesla at $36 a share, and now it's split 5-1 and it's worth $700 a share. Those are extremely rare. Like, I've done that three times in my life, twice with money that wasn't all that significant, and only once with money where it was really significant. The most money that I made in the markets has been with my buy and hold portfolio, right? My ETFs and my index mutual funds. So here's the problem. You missed the 10 best days in that 15-year period, right? So what are we talking about? Like, that's 3,500 trading days. That's like 4,800 days, 3,200 trading days or so in that 15-year period. So over 15 years, you missed 10 best trading days. Your return is now 20,929. You only made 5.05% over that same time period by missing only 10 days. Super important, right? So if you got out of the market today because we're up a little bit and you want to avoid some pain coming down the road, how long are you going to stay out? And that's a really important question, because we're going to talk about what comes next. So if you miss the best 20 days of the market, your return in that 15-year period was annualized at 1.59%, which means that you got a return that was below inflation in that time period, and you lost money. Like, on paper, you didn't lose money, but in terms of purchasing power, you lost money. You miss the best 30 days, you're down 1.18%. You miss the best 40 days, you're down 3.58%, or you've lost 5,786. So out of the 3,200 trading days or so, you missed the 40 best days in a 15-year period, and now you don't have any money left, right? So not any money, but you're down 5,786 rather than being up. Okay. So let's take a look here at some other research that was done. This was done over a much longer period, over 40 years, and this was done by Fidelity. So this was done between January 1st, 1980 and March 31st, 2020, which means it caught the very beginning of coronavirus pandemic and the panic. So if you invested $10,000 on January 1st, 1980, that would have grown to $697,000 and $697,421. Not too shabby over the trend. That would have been about 9.5% over time. We'll know when I check this a little bit later. Missing the best 5 days in that period took away essentially a third of your earnings. The best 5 days in 40 years. Can you imagine that? you were only out of the market for 5 days in a 40-year period, and it took away a third of your earnings. Now you have 432,411 rather than 697, right? Can you be sure that when you get out of the market, you're going to be missing enough bad days to justify also possibly missing one of these best 5 days? We're going to talk about why that's so important here in just a minute. All right. Miss the best 10 days in that 40-year period, and you have less than half of over a 40-year period. Miss the best 10 days, and now you have less than half of the earnings you would have had simply by buying and holding. That's all. You didn't have to be a genius. You didn't have to be smart. You didn't have to be interested in technology. You didn't have to do a ton of research. You simply bought an S&P 500 ETF. You made roughly 9.5%. You're better off than everyone who thought that they could time the market and they missed the best 10 days of the market. And see, it just gets worse. You miss the best 30 days of the market, and it's absolutely horrible. I'm going to move on here. So we need to take a look here, though, in the interest of being fair. What's the difference between missing the 10 worst days in the market and the 10 best days in the market? All right. So the picture looks significantly better, of course, if you miss the best 10 days in the market. But how can you guarantee that you're going to miss the best 10 or the worst 10 days in the market and be in the market for the best 10 days? And the answer is you probably can't, right? And I'm going to go on to this chart here. So this is the black line right here is the S&P 500 from 1998 to 2019. You put in $1 million at the end of that 20-year period. Now you have 5,045,000. Okay. If you miss the best 10 days in the market, you essentially lost half of your return. Now you're at $2.5 million. If you miss the 10 worst days in the market, though, it doubled your return. So now we're back on the other side of the equation. There's people watching this right now that are like, yeah, I can miss the worst 10 days in the market and double my return over the S&P 500, right? Here's a problem with that, okay? And this is just another company, JP Morgan, that's done the same research where you're fully invested, miss the best 10 days, whatever. You go through this is just looking at a different time period, January 2002 to 2021. But this is what they also found. 7 out of the best 10 days occurred within 2 weeks of the 10 worst days, right? Yes. And that Shula's show, that is exactly what I was getting to. This is what the research shows is that 7 out of the best 10 days occurred within 2 weeks of the 10 worst days. Okay. This is actually consistent across time periods. And most of the research that I looked at found exactly the same thing, that the timing, and it's because volatility is usually sandwiched between events, right? Volatility occurs in super narrow bands. And so you get the worst days and the best days kind of stacked on top of each other. Sometimes they're within days. I remember during the 2020 drop on a Monday, market was down the most it had ever been. And then I think by Thursday, the market was up the most it had ever been. Right. And it was that was an incredible ride. I remember I got in a political argument with someone, and they used that as evidence to say that Republicans were better at managing the market because that was the best day the market had ever had. I'm like, yeah, but it was back to back with the worst day the market had ever had. So stock market performance has zero to do with politics. Although I can make a case that no one here will like because I'm a nerd and I can show you statistics that will convince you of either argument, by the way. Yeah. So that's kind of the case here. And that's the one thing that people tend to forget. I've mentioned this a few times. I've made videos on this. People generally aren't interested in this video. So there's 16 people watching this live right now. I hope you're getting something out of this, that the evidence for market timing just isn't there. And yeah, and it's actually, it's pretty solid evidence too. And, avoiding the worst days in the market, yes, it can double your return, but if you're going to get out of the market and get back in within 10 days, are you really going to do that? All right. And you got to figure, the taxes you have to pay, right? You may be in a place where you have to pay commissions, although most people don't pay commissions anymore. If market conditions continue to deteriorate, or you miss that best day, you may not have enough money to buy back an equal amount of shares, equal to what you had before. You may be in a worse position. So anyway, that's just kind of what I wanted to present, largely because I know a lot of people, because we're up a little bit today, are probably thinking about selling. It's something that I kind of wanted to discourage. Holding is probably a better idea. There's also some great research out there for people who try to time the market versus people who invest their money as soon as they got it versus people who dollar cost average. All right. So, and the real distinction here is investing their money as soon as they got it or dollar cost averaging. There wasn't a giant statistical difference between just investing whenever you have money and doing the regular dollar cost averaging schedule. I know a lot of people simply don't have the patience to do that. And so they looked at like individual accounts, thousands of individual accounts over the long term over a long term of this study, and they noticed patterns that and they talked to people. They're like, oh yeah, it's like I don't always have money, but maybe one day every 2 months I have an extra 3,000 or $1,000 to invest, so I do that. And then they talk to other people that are like, yes, like clockwork, I invest $200 a month. These are my returns. There was not a statistical difference between those two, where there should have been, right? If you're looking at two individuals, there could well be a difference, but on average, because the sample size was so large, I think that it probably averaged out. I think that like one person in 10 years made $134,000 on their investment versus the other person who made like 135,000 or something. So it wasn't statistically significant. And I saw like 2 or 3 different studies on that. So yeah. But yes, Sheila's Joe, you are correct. The 10 best days usually occur soon after the worst 10 days. And we're kind of seeing that now. Remembering that the markets like nothing less than uncertainty, and anything that provides markets with certainty, fake or real, is going to cause the market to go up at this point. And that's kind of what we see happening today. Is we see the Fed's commitment to taming inflation in a big way, right? Half a point per month is a big way, which means that for the rest of the year we might get a quarter point, per quarter, rather than over the summer we're gaining a full point. So, but Collins gang says shake itself out. Absolutely right. Yes. That's the one thing about the inflation mess that we're in that no one wants to hear, is that the Fed could slap 2% interest rates on tomorrow, 3% on tomorrow, raise it by 9%. It's not going to end inflation immediately. It's going to take a very long time. Inflation is usually caused by supply shock. Everyone trying to say that this is the fault of the government. I don't care who is in power. It's not the fault of the government per se. It's supply shock. And unless you want a seriously interventionist government in our economy, there's really no way to anticipate supply shocks, right? We can look at other managed economies and talk about how well they've or other economies that are more managed than ours is, and talk about how they've managed to avoid inflation, and they have not. Inflation is worldwide right now because it's due to supply shock, and that's a tired explanation that no one wants to hear. People that are involved in shipping or procurement, they understand what's happening, right? You understand how much it costs now to ship something overseas, from overseas, versus what it cost, 2 years ago. And that has to do with the availability of ships, not being able to get in and out of ports, not being enough labor. There's basically not enough longshoremen to unload ships at this time. Not enough drivers to get it across the country. So you're paying a premium, right? Space is at a premium for shipping, and that's being paid right now. Eventually, markets will step in and correct that. More ships will be built. Wages will go up in that area. More truckers will be trained, or demand will decrease. But that was the point that people were trying to make at the people who were speaking at Davos this week, and the news that's coming out of there is that consumer demand looks good. People just aren't buying crap right now. They're going out and doing stuff, but consumer demand still looks good. Personally, for me, I think this is going to be good for a couple of businesses that I have. Maybe not so good for my own personal expenses, but yeah, that's where we are now. So why don't you guys let me know in the comments what you think about market timing? Talk to me about the moves that you've already made, because I know some of you probably have, and I'm happy to answer any questions. We can talk about investments. We can talk about mutual funds, individual stocks, ETFs, whatever you'd like to talk about. Still want to note that there's only 2 sectors that are up right now, and that is one of them is oil. That is 58 since the beginning of the year. That is up 58%, and utilities is up 4.35%, and even consumer staples is down 3.4% for the year. So a lot of what I'm looking at right now is actually going into financials and not just fintechs. A lot of the money that I'm putting into the market right now is going into your larger, stodgier investment banking related uh, financials, largely because you're going to see a lot more issuance of corporate bonds coming out. Right. And those are backstopped by these giant financial firms. And they don't take a ton of risk when it comes to selling this. Right. They just they just handle the issue. They take a commission from it, or I forget. It's not actually called a commission. It's called something else. I don't remember what they do. I don't remember the name, but they take virtually no risk. It's like the people who bring SPACs to market. The person actually creating the SPAC and bringing the SPAC to the market, the people who actually fund that take virtually no risk from it, right? All that risk is borne by two people. It's borne by the company issuing the shares, and it's borne by the people who buy the shares. But the actual SPAC, the people who put the SPAC together, they bear zero risk, right? So we're about to go through that coming up here pretty soon in the fixed income market. So even if we don't go through a recession, and let me put it clear. Let me say this pretty clearly. I think we're already in the middle one, right? So I think we're already in the middle of one. I think it's a relatively mild one compared to. It's going to be a relatively mild one compared to the last one we had, and I think that going forward, though, we should expect muted returns in stocks. In the past 45, 50 years, the S&P has averaged somewhere between 9 and 10%. I think we're looking at S&P over the next decade averaging 7 to 8%. Most of that due to the how low dividend payouts are. Typically, dividends represented about 40% of overall total return in your portfolio in the past. That's a lot between dividends and a reduction in bond payouts. I think that that's going to be a lot less going in the future. So we may see fixed income as a contribution increase in portfolios, but we're going to see dividend rates probably stay fairly low. So, um, what do you think about renewable energy stocks like AY or BPC? I'm very hesitant to invest in renewable energy stocks, largely because the existing energy companies have the capital to either buy them outright or outcompete them once it becomes commercially viable. So they're really just there to prove that that strategy is commercially viable, and then they actually have expertise. Uh, Exxon, in particular, in the early 2000s, pivoted to being an energy company and has actively explored and has expertise in essentially every single alternative energy except nuclear, of course. Nuclear energy is something I'm very interested in right now. I do think it's got to make a comeback at some point. Germany is one of those countries that completely abandoned nuclear after the Fukushima disaster in Japan. They voluntarily made themselves more dependent on coal and on Russian oil and gas voluntarily, right? They made themselves more independent on them for a couple of different reasons. And I think it would be really difficult for a country like Germany to bring back their operating plants back to power. But, this doesn't provide the automatic investment in uranium companies like you would think it would. And it has to do with how fast that fuel gets used up, right? So I think that investing in nuclear energy and uranium is actually going to be fairly tough. I also think that investing in alternative or renewable energy stocks could be problematic as well. Like we've seen a lot of distortion in the market, in those markets because of government subsidies, bailouts, because of irrational exuberance associated with some of those, and of course the equity risk premium almost disappearing for a couple of decades. So, well, for a decade. So, yeah. Elon's Ozolan says, got out of the market twice, lost money both times. It's important that you acknowledge that. And because you've acknowledged that, it probably means that over time, you're going to start outperforming almost everyone you know, because everyone that gets out of the market and loses money, even in my private, financial practice, sometimes I have a hard time convincing people that they would have been better off by staying. I can demonstrate to them clearly with numbers. Like I never met a chart I didn't like, never met a graph I didn't like. I can demonstrate this to them using this, and they still won't believe you. It's not that they don't get it. They're smart enough to get it. they just refuse to believe you. It's cognitive dissonance. It's something that so violates their expectations of reality that they simply can't accept it, right? And that's one of the things that fascinates me is cognitive dissonance. The few times that I have experienced it in my life, and I think it's just part of my personality, I don't experience it very often. The few times that I have experienced it, it's been earth shattering. But some people go through their entire lives, and this is all they experience from day to day is the denial of reality. And investing experience is one of those things that causes the denial of reality, like fairly frequently. People will not acknowledge that they made a poor decision, and they will make the same poor decision over and over and over. So, yeah, it's very interesting. So, wasn't planning on staying on too long today. So I did want to make an announcement. Early part of the week, next week, I'm going to be doing live streams. Latter part of the week, I might go somewhere, some time off, and then that next week, I'll probably be I might be away, like out of the country, or going down to Mexico on a surf vacation or something, or flying into the Caribbean. I haven't figured out exactly where I'm going to go. Like I literally live right next to Mexico. I can just drive across the border and go surfing if I want to. And but I'm going to do something, so I won't be doing too many live streams the second week in June. But I'll be back after that second week. So yeah, let's talk about what Sheila's Joe has to say here. Do you think the current bump in the market could be anything with when people get paid? Seems like to me the market is less frothy in the middle of the month. So the market is less frothy in the middle of the month because of news, not necessarily when people get paid. So in the U.S., in most states, you have to pay people at least twice a month, either that's on a twice a month schedule or on an every 2 week schedule. So that wouldn't make sense here in the U.S. Most states have that requirement. But I think it really has more to do with the news cycle and the release of certain figures. Like a lot of things come out like the third Thursday of the month or third Wednesday of the month or something like that. So yeah, I wouldn't. And with that observation, I would like to know if that observation is based on like empirical evidence or just an observation. So yeah, that's one of those things I'd like to know. Any questions you guys have here, I'm happy to answer. If not, I'm going to call this one kind of short today, and then I'll be working on videos to go out while I'm away on vacation this weekend, and I'll have those time to go out during the week. So you guys won't be completely free of seeing me, but I did want to say thank you to everyone who has done like super stickers or super chats in the last couple of weeks. It's not a lot, but I really appreciate that. Also, thank you to everyone who's kind of stuck through my channel when I went through periods where maybe I was depressed or something and didn't want to make videos, or I was so busy with my actual work that I wasn't able to get to videos. Sometimes I was down to like one video a week. And Sheila's Joe says, no evidence whatsoever. It's good that you acknowledge that. We want to on my channel, we want to be honest about our observations and honest about our feelings. It's okay to have feelings. It's better when those feelings are backed up with evidence. So Michael Will says, enjoy your holiday. Thank you. I will. Yeah, I'm looking forward to, hold on a second here. So what do you think about a plant-based food company like Tattooed Chef? So I looked at Tattooed Chef earlier or last year and was not impressed, but holy crap. Holy crap, Steven. Thank you. That is the largest single super chat that I've ever gotten. And I want to thank you very, very much. I'll be back first part of next week, Monday and Tuesday. I'll be doing these. But I won't be, but I won't be doing it probably like Wednesday through Thursday of the week. So, but yeah, back to Tattooed Chef though. What didn't see it as a compelling investment then? Plant-based food. And this is one of the things that is not a popular thought, but when I look at plant-based food companies in general, these are manufactured products, right? They're manufactured products, and they're going to get cheaper over time as volume increases. And I do think there's a possibility to really win eventually with something like Beyond Meat, or whenever Impossible Burger or Possible Meat decides to go public. I do think there's a possibility for that. It's just that it's been very, very expensive. Like I reviewed the stock. I never ended up buying any or anything like that, but it's something that I keep an eye on. And Elon's Ozolin says, I win every time I watch your live streams. Great info and great questions and answers. Information for free and quality info. Thank you. And thank you so much, guys. And once again, Stephen, like I said, that is the largest that's the largest amount of money I've ever gotten from a single person on a live stream. Just wanted to thank you so much. So everyone here have a very nice and safe weekend. And yes, I will see you on Monday.